Hey, what's up? Check this out. I got a comment a few days ago from Steve who said, another video idea. Sven Carlin just put out a video on dividends. You could respond and react to the stocks he mentioned: Intel, Cisco, 3M, Rio Tinto, Best Buy, and Verizon. Well, hey, what's up? I'm Russ. I've been dividend investing since 2018. Been welding for almost 23 years now, and I am a Navy veteran. And Steve C., today is your lucky day because I'm going to do my first ever reaction video to somebody that I've never seen before. I've never seen a Sven Carlin video. I don't know who Sven Carlin is. I've seen the name, so we're going to kind of go through this together and see what Sven Carlin has to say about dividends with "Dividends are the answer. Dividends will make you rich." So buckle up, Buttercup. Make sure you let me know in the comments below what you thought of this, if you enjoyed it, and you have any suggestions for future videos. So with that being said, let's see what Sven Carlin has to say about dividends.
Good day, fellow investors. The stock market is a little bit shaky lately, and many of you ask whether dividends are the way to go today. And even in the poll we made, most requests were for dividends. I'll also make Europe, and I'll also discuss real estate. That was highly requested, so for that I thank you very much. And of course, make sure to dividend up that like button to support the channel, and that it pays dividends for this channel forever. Thank you very much. Let's talk about...
Hey, real quick, dividend up. I love that. Hey, while you're at it, dividend up the like button. Give it the old confetti thumb for yours truly.
Dividends. Now, as the growth hope has deflated a little bit, the old tech changing the world is a little bit subdued, many of you think, okay, dividends are the reality in the investing world. We should now look for safety, for value, for dividends. And let me show you why you are completely right. Dividends are the way to go now, but also in general. So that's investing. Dividends are the result of investing. And yes, we'll also discuss Berkshire doesn't pay dividends. Yeah. So let me show you.
So again, this is kind of funny that Sven, I'm thinking maybe with the name Sven that he is Swedish. I don't know, but he's obviously English is not his first language, so it's kind of funny to hear him joke around like that. So I like his sense of humor. Nice, man.
Something here, the importance of dividends over time. This is a great article by Professor McQuarrie from the Santa Clara University showing stock market charts that you never saw. So very clear, an initial 10,000 investment in the stock market in 1927 is now 9.3 million of nominal wealth. This was in 2008, so now even higher. And this is the chart. We all know stocks only go up. Nothing can go wrong there. Sven, you're an idiot because you say that index funds are not that great, blah, 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 blah. But let's look at this. During the 1852 to 1942 period, inflation was intermittent. So deflation, everything was there, stagflation. Dividends accounted for almost all the total return. And this is a chart that nobody's showing you, how for 70 years stock went nowhere. So anything can happen next. But let's dig deeper. If we adjust the returns, the chart we have seen with inflation, and deduct the dividends, the 10,000 that went to 9 million just make 33,000 in real final wealth. And this is a chart again that nobody shows you. So yes, stocks go up and up, but in real wealth and deducting dividends, you see that there are big dry spells and nothing. So this is again 50 years of nothing, and then a little bit.
Now, that's a really interesting chart. I like that. So if you didn't catch that, what he's saying is that the blue line is, I believe, inflation and dividends included, and the red line is without inflation and dividends. So you can really see the stark difference of what dividends can do. It literally is turbocharging investments, and yeah, that looks huge. Nice.
Up, down to 2009. Now we are up again, but it's very likely that from this up here, we'll again have a lot of years of nothing. So if we account for this inflation and dividends, the truth is that since 1928, dividends plus inflation accounted for 99.7%.
I love it. Like, so this looks a little confusing to me as somebody that does a lot of editing. So he's got a lot of yellow on there. So how important is that? Look at that. He's got a red line under it. It's highlighted, and he's got the box over it showing that since 1928, dividends plus inflation accounted for 99.7 of the nominal wealth produced. So that's not inflation adjusted wealth. That would be nominal wealth, cold hard dollars. Really interesting, Sven.
Of the nominal wealth produced as of 2008 by investing in stocks. So yes, dividends and inflation. That's why dividends matter. So when you think about...
Can we get a shirt that says dividends matter? Is it wrong? Dividends matter.
Yes, it is all about dividends. Let's dig deeper. And then, of course, I make a valuation of the S&P 500, then I get comments, Sven, I cannot understand your valuation on dividends. Now the world is different and you should value on earnings, buybacks, this and that. Why don't I stick to dividends to give you the real value? Be conservative. If you're right, good. But be careful if somewhere in the next 20 years I end up right. And I did that here in this video. I will put the link in the description below for those that missed it.
Hey, you gotta love it. As a YouTuber, I appreciate that. We're always trying to get you to go to the next video, so good on him.
Now there is the second argument. Yes, but Berkshire doesn't pay dividends, so you are totally wrong. Am I? Berkshire portfolio, dividend company, dividend with buybacks that push up dividend per share, dividend. If we go deeper, Berkshire takeover for Burlington Northern Santa Fe, 32 billion paid in the first year immediately. What is this? Dividends, and look at the payouts from Burlington over the last years. Now it's already a 15%.
Oof. Now look at that down there. Berkshire is getting over 4.83 billion in dividends from Burlington, and in 2010 it was 1.24 billion. So look at the power of compounding and growing dividends. And I don't know if he's going to touch on this, but I just want to say really quickly with Berkshire, Warren Buffett makes the joke that they once paid dividends sometime in the 1960s when he was in the bathroom, and then that went away. But basically, in a nutshell, the reason that Warren doesn't like to pay dividends is A, he thinks he can do a better job reinvesting those dividends and growing them than you can. And B, when you receive dividends, when we receive dividends, it is a taxable event that's triggered. So we have to pay taxes on those dividends. And in the United States, you don't if you're under a certain annual income, but generally most people are going to pay taxes on those dividends in a taxable account. So he likes to buy back shares and reinvest those dividends in other businesses and growing Berkshire Hathaway, because then you have the optionality to decide when you want to sell those shares and when you want to get income from the sale of those shares, and then you pay dividends. So it's the optionality he's giving you to sell when you want to sell. So I'm sorry, Sven, continue, my man.
Dividend yield on what Berkshire paid, and that's investing, and sooner or later it has to come to dividends. As Berkshire grows in the next 10-20 years, maybe again it will start paying dividends if there is no other. But for now they have investments. But keep in mind, Berkshire is about Warren Buffett reinvesting those dividends for you. So again, yes, it is about dividends. If we go to Coca-Cola, look at how much he paid for it, 1.3 billion, and he's now getting 700 million per year in dividends. Yes, dividends. That's why he's investing, holding it, and reinvesting these dividends for Berkshire's wealth. So even with Buffett, it's all about dividends. But yes, dividends are just part of the shareholder reward. If we look at how the structure of shareholder rewards works, we have earnings, and then those earnings are redistributed depending on how the company decides. They can pay dividends, buybacks, or they can be reinvesting into new businesses and grow businesses, merger acquisitions, and whatever.
Or all three, like my PepsiCo is doing. And many other fine companies do this.
However, whatever they do here the point of it is to increase the dividend per share. If they do buybacks, less shares, thus the dividends go up. If they invest, future potential dividends go up. This is Berkshire, they always invest, but that's just Warren Buffett doing the job for you. And the conclusion is that 99.7% of returns long term, as the valuations, as the interest rates, as all the noise evens out over the long term, it is about inflation and dividends. And those dividends grow and make your wealth over time. That's how it is. Now you can be smarter and buy more when it looks ugly and sell or rebalance or change when it looks good. But over time, it is about the business and the dividends and the growth that it allows you to reinvest.
I gotta highlight that. It's about the business. So if a newer investor may look at that high yield and get attracted to the really high yield, which is fine, but then it's time to investigate and look at the business. So we always say buy the business, not the dividend. Buy the business that's paying the dividend, and a strong business will continue to pay and grow the dividend. But a business that's shaky, that dividend's going to eventually get cut or go away altogether if and when that business does go away itself. So I love what he says is to buy the business. We can't emphasize that enough.
Like Warren did with Coca-Cola, American Express, and he's now doing with Apple also. So sooner or later it is about those dividends, and dividends are a function of earnings. So yes, earnings lead to dividends. So you can focus on earnings, but it's easier to focus on dividends because those are the real thing there. This is redistributed, but I focus on earnings, but at the end it should all lead into something tangible for you to as an investor. Because of course, if there are no earnings, there will be no dividends. And now let's look a little bit at the investing options, the normal funds. I don't know what these funds do that have 7%. This is something strange likely. And if we look at the normal options,
I like that he pointed out the one that has a 7.56% yield, the ETF, because always be skeptical of high yields from companies and ETFs, both, because if that ETF is holding a bunch of businesses that don't pay a high yield, where's that coming from? It's got to be coming from somewhere in order to pay you, and it's likely coming from leverage, which makes things risky. So again, I like that he pointed out the high yield ETF, and he said something funny is going on there, which I agree.
The dividend yields in the environment aren't that stellar. So 1%, 2%, maybe 3%. So dividend aristocrats. Nothing too, let's say, really, really great. But I've looked at a few companies, and we have all analyzed these companies here on the channel. I think this will come tomorrow. So if we look at the companies, this is already something. This is already an average of 5%. So one can, let's say, build a dividend portfolio. However, keep in mind all of these, some are cyclical, some are older businesses, some are this, some are that. So
really quickly, I see we only have a few minutes left in this video. It doesn't look like he's going to go into them. He did say they have links to all those except for Best Buy. I will say I do own Intel, Cisco, Verizon, and 3M. I do not own Best Buy or Rio Tinto. Best Buy I think is interesting because from what I've read, they're becoming more of like a real estate company in a sense that they are leasing out space inside their stores to Apple and Samsung and different companies that want to pay them to have that, be exposed to that foot traffic in their stores. And Rio Tinto, I've never really dug deep into. I know my guys on the Dividend Talk podcast over in Europe really do like them. They are a European company. I think they are one of the largest miners, and they also do pay a variable rate dividend, I believe, which I do like variable rate dividends. They're not great for people that are living on the incomes because it can be a little bit lumpy, meaning that with a variable rate, you receive what they are paying out as a percentage of their earnings. So they're not committing to a specific yield. And if times are lean, you get small dividends. If times are booming, you're going to get big fat dividends. Like right now for Rio, they're able to pay a big fat dividend, but it does make it risky going forward in the future. So again, I guess he's not going to go into them. I do like them all. I do like Intel and Cisco. I'll be talking more about them. But anyway.
This is investing, but at least you get something. And if you're happy with a 3% dividend and you find 20 businesses that give you 3-4%, it's very unlikely that you will be hit hard. And the dividend yield will allow you to reinvest, compound the wealth, and do really well over time. Of course, if you can find higher dividends, better, even better. Plus, if you can find good dividends,
if you can find higher dividends, even better. Yes, if it's a good company. So again, I think he would agree with that. Make sure you're buying the business. And again, just look at the business. Don't just buy that dividend yield.
that have 2 buybacks and have reinvesting into the business at a high return on investment, then you are really looking for the jackpot. That's always what we look for. Or low earnings that will allow for future increases in dividends per share, etc., etc. So that's deeper, second level investing. But let me tell you something now that will freeze your mind, because it's boring, because it's this, but it's the core of investing. Dividends, inflation, is what makes your return over decades. Buybacks, yes, now it works, this and that, great. But over decades, and here your mind shuts off, decades, Sven, I don't know what will I eat tonight, don't talk to me about decades. But unfortunately, investing is about decades. And when you allow the power of dividends and etc., etc., even if there is no dividend now, the potential of it coming in the future, that's investing. And if I
want to say beautiful, I love that point. I'm trying to think in decades. We should be thinking in decades. And there's that old saying, right, that people underestimate, or I'm sorry, people overestimate what they can do in a year or in a short amount of time, and they underestimate what they can do in a long period of time, like a decade. So I love that he pointed that out, to be thinking in decades. That's beautiful.
Go to my table of outlook for the next 20 years. So investing into businesses is best, reinvesting dividends also for compounding, and of course lower stock prices are better for reinvesting those dividends. So this summarizes a little bit.
Again, I love it. He said the lower stock prices, price goes down, yield goes up, we get more bang for our buck.
But I would say don't focus on dividends like, okay, I need a dividend, look at the 6-7%. Focus always on investing in businesses and think, okay, where will the dividend be in 10 years? Or if there is no dividend, will the return on investment still be there for growth? I also own businesses that pay no dividends. I own some that pay dividends and that allow me to reinvest those dividends over time and compound my wealth. That is investing. And if you have a perspective of 10, 20, 30 years, everything becomes easier. That's the key of investing. That's the key of dividends. And also eliminating everything else eliminates the speculation, the hanky-panky that we have seen going on over the last 10 years. But investing is about more than the last 10 years, and that's why you're watching this channel. If you are looking for the next 10x stock, you already stopped watching at the second minute of this video. So, thanks for watching. Dividend that like button, and I'll see you in the next video.
If you like this and you got a suggestion, let me know in the comments below. And for one of the fun videos that I did, I went over the 10 commandments of dividend investing. I'd love to know which ones I missed, what you would have put on the list that I missed. So click the little box next to my head and I will talk to you there.